What is unrealized and realized profit and loss in Forex? How to calculate profit and loss in with pips? What is rollover and interest rate? Welcome to Forex Sonic, Forex Audio Library. Today we are going to learn 18 to 20 pages in Chapter 2 named The Mechanics of Currency Trading from the book Currency Trading for Dummies by Mark Galant and Brian Dolan. So let's start. Unrealized and realized profit and loss. Most online Forex brokers provide real-time mark-to-market calculations showing your margin balance. Mark-to-market is the calculation that shows your unrealized P&L based on where you could close your open positions in the market at that instant. Depending on your broker's trading platform, if you're long, the calculation will typically be based on where you could sell at that moment. If you're short, the price used will be what you can buy at that moment. Your margin balance is the sum of your initial margin deposit, your unrealized P&L, and your realized P&L. Realized P&L is what you get when you close out a trade position or a portion of a trade position. If you close out the full position and go flat, whatever you made or lost leaves the unrealized P&L calculation and goes into your margin balance. If you only close a portion of your open positions, only that part of the trade's P&L is realized and goes into the margin balance. Your unrealized P&L continues to fluctuate based on the remaining open positions, as does your total margin balance. If you've got a winning position open, your unrealized P&L is positive and your margin balance increases. If the market is moving against your positions, your unrealized P&L is negative and your margin balance is reduced. Forex prices change constantly, so your mark-to-market unrealized P&L and total margin balance also change constantly. Calculating profit and loss with pips. Profit and loss calculations are pretty straightforward in terms of math. They're all based on position size and the number of pips you make or lose. A pip is the smallest increment of price fluctuation in currency prices. Pips can also be referred to as points. We use the two terms interchangeably. Looking at a few currency pairs helps you get an idea of what a pip is. Most currency pairs are quoted using 5 digits. The placement of the decimal point depends on whether it's a JPY decimal point. All others currency pairs have 4 digits behind the decimal point. In all cases, that last itty-bitty digit is the pip. Some major currency pairs and crosses, with the pip underlined, are given in the description of the video. Focus on the euro to US dollar price first. Looking at euro to US dollar, if the price moves from 1.2853 to 1.2873, it's just gone up by 20 pips. If it goes from 1.2853 down to 1.2792, it's just gone down by 61 pips. Pips provide an easy way to calculate the P&L. To turn that pip movement into a P&L calculation, all you need to know is the size of the position. For a 100,000 euros per USD position, the 20 pip move equates to $200, 100,000 euros 0.0020 equals $200. For a 50,000 euros per USD position, the 61-point move translates into $305, 50,000 euros 0.0061 equals $305. Whether the amounts are positive or negative depends on whether you were long or short for each move. If you were short for the move higher, that's a in front of the $200. If you were long, it's a plus. Euro to US dollar is easy to calculate, especially for USD-based traders, because the P&L accrues in dollars. Remember, if you take US dollar to Swiss franc, you've got another calculation to make before you can make sense of it. That's because the P&L is going to be denominated in Swiss francs, CHF. After all, CHF is the counter currency. If US dollar to Swiss franc drops from 1.2267 to 1.2233 and you're short 100,000 US dollars for the move lower, you've just caught a 34 pip decline. That's a profit worth 340 Swiss francs, 100,000 US dollars, 0.0034 equals 340 Swiss francs. Yeah, but how much is that in real money? To convert it into USD, you need to divide the 340 Swiss francs by the US dollar to Swiss franc rate. Use the closing rate of the trade, 1.2233, because that's where the market was last, and you get 277 US dollars and 94 cents. Even the venerable pip is in the process of being updated as electronic trading continues to advance. Just a couple of paragraphs earlier, we tell you that the pip is the smallest increment of currency price fluctuations. Not so fast. The market is rapidly advancing to decimalizing pips, trading in 1/10 pips, and half pip prices have been the norm in certain currency pairs in the interbank market for many years. Hey everyone! If you're enjoying our Forex audiobooks channel, please help us out by subscribing to the Forex Sonic, liking any videos you find helpful, and sharing them with your friends or anyone else who might find them useful. We'd also love to hear your comments and feedback, so please leave a comment on any video you watch to let us know what you think. Thanks for your support. Factoring profit and loss into margin calculations. The good news is that online FX trading platforms calculate the P&L for you automatically, both unrealized while the trade is open and realized when the trade is closed. So why did we just drag you through the math of calculating P&L using pips? Because online brokerages only start calculating your P&L for you after you enter a trade. Tip: to structure your trade and manage your risk effectively, how big a position? How much margin to risk? You're going to need to calculate your P&L outcomes before you enter the trade. Understanding the P&L implications of a trading strategy you're considering is critical to maintaining your margin balance and staying in control of your trading. This simple exercise can help prevent you from costly mistakes, like putting on a trade that's too large or putting stop-loss orders beyond prices where your account falls below the margin requirement. At the minimum, you need to calculate the price point at which your position will be liquidated when your margin balance falls below the required ratio. Understanding rollovers and interest rates. One market convention unique to currencies is rollovers. A rollover is a transaction where an open position from one value date, settlement date, is rolled over into the next value date. Rollovers represent the intersection of interest rate markets and Forex markets. Currency is money, after all. Rollover rates are based on the difference in interest rates of the two currencies in the pair you're trading. That's because what you're trading is good old-fashioned cash. When you're long a currency, it's like having a deposit in the bank. If you're short a currency, it's like having borrowed a loan. Just as you would expect to earn interest on a bank deposit or pay interest on a loan, you should expect an interest gain/expense for holding a currency position over the change in value. Think of an open currency position as one account with a positive balance, the currency you're long, and one with a negative balance, the currency you're short. But because your accounts are in two different currencies, the two interest rates of the different countries apply. Tip: the difference between the interest rates in the two countries is called the interest rate differential. The larger the interest rate differential, the larger the impact from rollovers. The narrower the interest rate differential, the smaller the effect from rollovers. You can find relevant interest rate levels of the major currencies from any financial market website. Look for the base or benchmark lending rates in each country. That's it for today, and thank you for listening to Forex Sonic. We hope you learned a lot from today's activity. The next part of the book will be uploaded in upcoming videos.